talking about long-term assets, and we are going to focus on what we add to assets and what is expensed versus what we add to the assets in order to depreciate them. So, fixed assets. Fixed assets are tangible. There's a physical presence to them. Equipment, machinery, buildings, and land. Sometimes you call them property, plant, and equipment. Fixed assets have these characteristics. They physically exist, which is why we call them tangible. They are owned and used by the company in their normal business operations, and they are not offered for sale as any part of normal operations. So we know that certain companies may sell inventory that may be a building, or they may sell equipment such as tractors in their normal operations. That would not be a fixed asset to them. That's current inventory. So when you see a John Deere store that sell those assets, that's a little different. That is normal inventory for them. But we're talking about people, companies that actually utilize these assets in their normal operations, okay? So do you understand the difference between someone that sells inventory versus someone that purchases equipment for uses in their normal operation? Okay, that's what we're talking about here. Fixed assets are needed for many businesses. A cost that has been incurred can be classified as a fixed asset. It could be classified as an investment, or it could be classified as an expense. Items are classified as fixed assets, such as land, buildings, or equipment. They need to last more than a year, and they're used in the normal operations of the business. Standby equipment for use during peak periods or when other equipment breaks down is still a fixed asset. Fixed assets that have been abandoned or no longer used in operations technically are not classified as fixed assets. So here's how you look at it. Is the item purchased? And if that item's been purchased, is it long-lived? Meaning, will it last for more than a year? If it won't last for more than a year, we're going to expense it on the income statement right away. If it will be utilized for greater than a year, then we say, is this asset used in normal operations? If it's used in normal operations, it would be a fixed asset. If it's not used in normal operations, if it's used to hold on to it, to in turn sell it down the road to make money, that would be an investment. In addition to just the purchase price, the cost of acquiring fixed assets include the amounts spent getting ready for the asset to be put in place and ready for its intended use. Only costs necessary for preparing the fixed asset for use get included as a cost of the asset. Unnecessary costs that don't help the asset's usefulness are expensed. So expensing items is, say an asset gets beat up, vandalized. To fix that asset, we would expense it. If the asset was being installed and somehow the installation screwed up, to fix those mess ups, that would be an expense. Theft on an asset that's not insured would be an expense. Damage during the packing or unpacking of the asset would be an expense. Fines, all of those would be expenses, not costs that get added to the asset. Here are some examples of costs that get added to the asset. If we're dealing with a building, architect fees, engineer fees, insurance costs during construction, only during that time, because we know insurance costs on an annual basis, just like property taxes on an annual basis, are expensed. But while the building is being constructed, all the costs related to utilities, insurance, interest get added to the cost of that asset. Interest on money borrowed, sales taxes, repairs, purchase of existing buildings. So let's say we purchase an existing building, but we need to fix that for our purposes. That would be added to the cost. Modifying its use, permits, all those get added to the cost of an asset, and we depreciate those costs. Machinery and equipment, if you pay sales tax on that machinery, we add that to the cost. Freight, installation, repairs on the purchase of a used equipment that will extend its life, we will write that off. Insurance while in transit, assembly, modifying it, testing it, all of those get added to the cost of machinery and equipment. Land is a unique asset we'll talk about in a minute, but what would get added to land would be, I've never heard of sales tax on land, but there are taxes on land, permits, broker's fees, title fees, surveying fees, delinquent real estate taxes. So say you purchase a piece of land, but they haven't paid taxes on it for the past 5 years. And so your agreement is to pay those 5 years of taxes to buy it. Those past 5 years of taxes would be added to the price of the land for your purpose. Removing unwanted buildings and grading and leveling land all gets added to the cost of the land. So assume Kimball Inc. purchased equipment for $12,000. Freight costs of $600 were incurred to transport the equipment to the installation site. On site, installation costs of $1,500 were incurred, including $500 due to an error in installation. The journal entry to record the equipment would be shown as the $12,000, the purchase of it, the $600, the freight to transport it, and the $1,000 of installation. The screw up of $500 you would expense. Does that make sense? So the equipment would be $13,600, and the $500 that was due to a screw up would be part of just a repair expense. A company can incur costs associated with constructing a fixed asset, such as a new building. The direct cost incurred in the construction should be capitalized, which means added to the cost of the asset. When the construction is completed, the costs get switched from construction in progress to the asset account. Now, leasing is something very different. Leasing is when you are going to use an asset for a period of time, but you're not going to actually buy it. Now, there's two kinds of leases we'll talk about, but an operating lease is generally when someone else owns the asset, but you're going to pay to use it for a period of time. Okay? It's basically paying rent on an asset for a period of time. That would be an expense. There are types of assets that, even though it shows on paper you're technically not buying it, you're basically going to be using it for greater than 90% of its useful life, which we call a capital asset. I don't think we're getting into it yet. But know that leasing an asset, you have access to the asset, but you're not necessarily purchasing it. Expenses such as maintenance and repair costs are ultimately the responsibility of the lessor. So how many of you guys know someone who rents an apartment or rents a home? That is a lease, basically, where they don't own it, but they have use to that property. Okay, there are two types of what we call leasing. One is where you use it for a period of time. Another is where you basically are treating it as a lease, but you're basically purchasing the asset or using it for most of its life. So we'll get into that at another time. But let's start with this one. Melinda owns and operates ABC Print Company. During February, ABC incurred the following cost in acquiring 2 printing presses. One printing press is new, and the other was purchased from a business that recently filed for bankruptcy. So the cost related to the new printing press, fees paid to the factory representative for installation, freight, insurance while in transit, new parts to replace those damaged in unloading, sales tax on the purchase price, and a special foundation. So which of those costs will be added to the price of the asset? All of those except for the new parts to replace those damaged in unloading. Why? Since that was a mess up, those costs will be expensed. But all the other costs, fees paid for installation, freight, insurance, sales tax, and to create a special foundation for the equipment will all be added to the cost of the equipment. Now, the used printing press, which of these will be added to the purchase price of the used printing press? Fees paid to review the purchase agreement, freight, installation, replacement of worn out parts. But those items such as repair of damage incurred in reconditioning the press and vandalism, those get expensed. Okay? Make sense? Now, On Time Delivery Company acquired an adjacent lot to construct a new warehouse, paying $60,000 in cash and giving a short-term note for $100,000. Legal fees paid were $1,250. Delinquent taxes assumed were $10,000. Fees paid to remove an old building from the land were $8,000. Materials that were salvaged from the demolition were $1,500. A contractor was paid $415,000 to construct a new warehouse. What's the cost of the land that's going to be reported on the balance sheet? Well, it's going to be the purchase price of the land, which was the $100,000 plus the $60,000. So they gave $60 in cash and took out a note of $100. So the whole land was $160. The legal fees, the delinquent taxes, and demolishing the building will all get added to the cost of the land. The amount that they received for selling some of those salvaged materials will get subtracted from the land cost. So it's the net amount is what you add to the land. So since they took down the building, it cost them $8,000, but they received $1,500 cash for some of the materials. They net that. So the cost of the land that we would show on the balance sheet would be $177,750. Make sense, guys? Now we're going to get into some fun parts. An asset is treated on the balance sheet as a fixed asset, long-term asset. But over time, apart from land, we never depreciate land because we say there's only so much land, it's not going to lose its value. But over time, fixed assets get worn out. The cost of fixed assets, such as equipment and buildings, get recorded as an expense over their useful life. Recording the cost of fixed assets as an expense is what we call depreciation. Land is never, ever depreciated. So if you think of this building's probably been around almost 40 years. It's not what it was 40 years ago. Buildings wear out. So a portion of this building we take as what we call depreciation expense every year because we purchase an asset for a lot of money, but it does reduce its usefulness over a period of time. It might need to be replaced, updated, all the things that keep it going. But we call it depreciation when we take a bit of that expense of the asset. Depreciation can be caused by physical or functional factors. Physical depreciation include wear and tear during use or from exposure to weather. Functional depreciation, such as obsolescence or changes in customers' needs that cause the asset to no longer provide services for which it previously was intended. Here's a mistake about depreciation. Depreciation doesn't mean the asset's declining in value. It's basically, for our purposes, an allocation of the asset's cost over its useful life. The book value of a fixed asset usually doesn't agree with the asset's market value. So if we were to see what they paid for this building back in the 70s, plus any of its improvements, divided by the depreciation they've taken, it doesn't mean that that is what the building's actually worth today. Because remember, we, for accounting purposes, show assets on the book at what we paid for them, not at what they're really worth. Does that make sense? Oh, depreciation does not provide cash to replace fixed assets as they wear out. The three factors that determine the depreciation of a fixed asset is what we initially purchased it for, what we estimate its useful life to be, and then what we think is its what we call residual or salvage value. The initial cost of a fixed asset is what we purchase it for, plus all the costs to get it ready for its use. The expected useful life of a fixed asset is the estimated length of time the asset will be used in normal operations. Guys, all of this is an estimate though, because we don't really know how long it's going to last, but we estimate it accordingly. The residual or salvage value of an asset is the estimated value of the asset at the end of its useful life. It's estimated at the time the asset is placed in service. Sometimes you call it scrap value, salvage value, or trade-in value. The depreciable cost of an asset is the difference between the fixed asset's initial cost minus its residual value. That amount is what we're going to use to depreciate it over its useful life. So let's just think of a truck. Let's just kind of assume that a truck, a company purchases it because they're using it in their normal operations. They're going to estimate how long they think that truck is going to be in business for, how long they'll be able to utilize it. What they estimate that amount of time is how long they'll depreciate it. Here we've got a company, Exeter, purchases a forklift on January 1st. They paid $24,000 for the forklift. They think once they're done with their use of the forklift, it's going to be worth about $2,000. And they figure its useful life for the company is 5 years. So the way in which this forklift gets depreciated is you take the initial cost minus the residual value. So the $24,000, what they purchased it for, minus the residual value of $2,000, gives us what we call a depreciable cost, what we'll use for depreciation purposes of $22,000. If we think it's going to be used for 5 years, we'll take a portion of depreciation for year 1, year 2, year 3, year 4, and year 5 for all 5 years. The 3 main methods that we're going to talk about involve straight line, which is the easiest method, units of activity, which is pretty straightforward too, similar to straight line, and double declining. Double declining can be a little tricky, but I'm going to give you some easy ways to figure that out. It's not necessary for a company to only use one method of computing depreciation for all its assets. There are benefits with the different methods, and we'll talk about that. Straight line is the most simple. In straight line depreciation, we're going to take the same amount of depreciation for each year. So if the cost minus the residual value of an asset is $22,000, and we're saying its useful life is for 5 years, we'll take $22,000 divided by 5 years, which averages $4,400 a year. And straight line is so easy. We're just going to depreciate $4,400 every single year with straight line depreciation. Year 1, we take 20% of the depreciable cost. Year 2, year 3, year 4, year 5. Easy. Straight line depreciation. Same amount every year. Computing straight line depreciation is basically, we can take 100% of the depreciable cost, divide that by 5 years, or 20% of the depreciable cost every year. Okay? So if we want to have depreciation of 8 years, we would take 100% divided by 8 to come up with 12.5% a year. Or if it's 10 years, 10% a year. 20 years, 5% a year. You turn it into a percentage method, or a percent of the total. Depreciation on the forklift for the first year is shown as a debit to depreciation expense and a credit to this contra account called accumulated depreciation forklift. We don't actually offset the asset because we want to know what is the original price we paid for that asset. And we also want to know how much depreciation have we accumulated on this asset. Does that make sense? So we keep them separate. Now, the net cost of the asset is going to be the fixed asset minus the accumulated depreciation, which show us the net cost. We know that depreciation expense is an expense on the income statement. Accumulated depreciation accounts are contra accounts. This is since their accumulated depreciation accounts get deducted from their related fixed asset account on the balance sheet. Okay, that's our book value of the asset, or we could call it the net book value. Here, you see that after year one, when we take $4,400 of depreciation, do you see now the net book value of that forklift is $19,600? After year two, the net book value would be $15,200. It'd be the $24,000 we bought it for minus $4,400 the first year gives us our $19,600. Or the $24,000 we bought it for minus $8,800 at the end of year two gives us $15,200. At the end of year three, our book value is $10,800. At the end of year four, it's $6,400. And do you see at the end of year five, the book value is what our residual value is? Because we're not going to depreciate it below that residual value. Remember when we come up with the depreciable cost, we take the cost of the asset minus its residual value. Do you remember that when we started? Yes? That's one method. That's one method. Here's the next method. It's pretty similar also. The units of activity method provides the same amount of depreciation expense for each unit of activity. Depending on the asset, the unit of activity could be hours, could be miles, or quantities produced. For manufacturing assets, the units of activity are often expressed as units of product. So, the units of activity method is figured by the cost minus the residual value divided by the total estimated units of activity. So, do you know when we were doing straight line, we were doing it over a period of years. But for that forklift, we could do it over the number of hours. We can estimate the hours we believe this forklift's useful life is. And depending on how many hours each year, we can take depreciation based on some method of activity. For the forklift, based on units of activity, we are estimating, say they figured it based on hours, and they're coming up with so much per hour. The depreciation expense on the forklift is $4,620, and the accumulated depreciation for the forklift is $4,620. No, as you see, for year one, the forklift showed 2,100 hours used. In year 2, it shows 1,500 hours used. Year 3, 2,600 hours. Year 4, 1,800 hours. Year 5, 5,000 hours. So basically what's happening is the depreciation is based on some activity, in this case, hours of use. Ultimately, when they calculate those number of hours of use, after the end of those number of hours they anticipate that forklift to be used, will come up with the residual value. So this is a flat amount per hour used, and then based on how many hours of use each year is how they calculate the depreciation. So guys, this is very similar to straight line, except splitting it over a number of years, we split it over either miles or number of hours. Okay? Pretty much the same method. Declining method is a whole different animal. Okay? Totally different. The double declining method provides a declining periodic expense over the expected useful life of the asset. Basically, we take the straight line amount, determine the straight line percentage using the expected useful life, but double it by 2, multiply it times 2. Compute the depreciation expense by multiplying the double declining balance, or the double balance rate, times the book value of the asset. So here's how it works. If we say that a forklift is going to be a useful life of 5 years, right? And we take the cost of the asset, divide it by 5, and multiply it times 2. That's how we get the double declining balance. There's going to be a lot more at the beginning of the life of an asset, and it's going to decrease rapidly. As you see here, and here's the difference with double declining. You know what the other two methods, we take the cost of the asset minus the residual value and then come up with a percent? We don't do that with double declining. With double declining, we take the cost of the asset, multiply it, or divide it by the straight line times 2. Or we take the cost of the asset, $24,000 times 40%. Then what we do, at the end of year 1, we show the cost was $24,000 minus our $9,600 we took in depreciation, gives us an ending book value for year 1 at $14,400. We then take the $14,400 times 40%. See what we're doing? We're taking the new book value times 40% to then, for year 2, get $5,760. So then we take the book value at the end of year 2, which is the $14,400 at the end of year 1 minus the $5,760, to come up with a new book value at the end of year 2 of $8,640, and we'll multiply that times 40%. We keep doing that until we hit the residual value. Do you see at the end of year 4, our book value is, our adjusted book value is $3,110. If we took that $3,110 times 40%, wouldn't we have gone below the $2,000 book residual value? See, we can't do that. So at the end of the double declining method, we have to make sure we only take enough depreciation to hit the residual value. We can't go below it. Does that make sense? Yes.
Can you go back to the formula for this?
Yes. We take Unlike the other two methods where we took the book value minus the residual value to come up with our depreciable cost, with double declining, we don't do that. We take the cost of the asset, we divide it by the straight line method, and multiply it times 2. The reason we took 40% here is this forklift was a 5-year property. And how much would we normally take for straight line for 5-year property? 20%. But since we double it, do you see why we take 40%? Think of this, guys. What if this was 3-year property? Under straight line, if it's 3-year property, how much would we take? 1/3? If it's double declining, what will we do? Take 2/3. Does that make sense? But we only take 2/3 of the cost. So in year 1, we take the cost of the asset times double the straight line. But do you see at the end of year 1, we take our $24,000 minus the $9,600 to come up with the adjusted book value. So in year 2, when we go and figure out depreciation, do you see we only take $14,400 times 40%? Okay? We adjust it every year. Yes?
Do like real estate, do they use this so they can write off more depreciation?
Up front, correct. And the thinking is that that asset gets used more and worn out more in those first years. Okay? Does that make sense? When the double declining method is used, the estimated residual value is not considered except at the end. The asset should never be depreciated below its estimated residual value. This accelerated depreciation method gives more depreciation in the first year of its asset's use, and then it starts declining significantly. Okay? Double declining shows we've got $9,600 in year 1, we've got $5,700 in year 2, $3,400 in year 3, $2,074 in year 4, and we only take $1,110 in year 5 because we cannot go below the residual value. Where students screw up on this is they'll just continue to take that adjusted book value times 40%, but you can't do that. You have to be aware you can't go below the residual value at the end of its life. Okay? So here you see the book value when we look at the double declining method goes down pretty fast, right? So after year 1, that adjusted forklift book value is $14,400. At the end of year 2, it's $8,640. At the end of year 3, $5,184. At the end of year 4, $3,110. And it can't go below $2,000. Okay? No. Straight line is easy. Units of activity really is easy too. It's going to vary based on the number of miles or the number of hours, but it's straightforward. The double declining, students can have a tough time with, but as long as you get the concept that the adjusted book value gets adjusted at the end of each year, and so that double declining percent we take is only based on that new adjusted book value at the end of each year. Okay? All 3 methods allocate a portion of the total cost of an asset to an accounting period, but you can't ever go below the residual value. The straight line method provides for the same periodic amounts every year. The units of activity provide for periodic amounts that vary depending on the amount the asset was used. And the double declining provides for a lot more depreciation at the beginning, the first year of a life, followed by declining amounts. Okay? Now, that's in a perfect world when we start an asset on January 1st. A fixed asset can be purchased and placed in service other than the first month of an accounting period. In such cases, depreciation needs to be prorated. Assets placed in service during the first half of a month are normally treated as having been purchased on the first day of the month, and assets purchased during the second half of the month are usually treated as having been purchased on the first day of the next month. So, if we're looking at the straight line method, and we assume that Exeter bought this forklift on October 1st instead of January 1st, then it's going to be done a little different. Think of this. Normally there are 12 months in a year. If this forklift was purchased on October 1st, don't we only have 3 months for the first year? October, November, and December? Does that make sense? So we're only going to depreciate, if $4,400 would be for the full year, we're only going to take 3 months out of 12 months, correct? 3/12 of that for the first year. So if you think about it, year 1 is just 3 months. Then we're going to have year 2, 3, 4, 5, and then year 6, we're going to get 9 months of it, aren't we? Right? Because it's 5 full years. Under the units of activity, it's actually going to be the same thing in that if there are $2.20 per hour, we'll just figure how many hours was it utilized in that first 3 months, and that's how we calculate the units of activity. For double declining, we'll estimate what it would be for the full year, but we'll only take 3/12 of it. Make sense? Yep. The second year of depreciation and double declining will be taking that adjusted book value by the declining rate. So in year 1, the amount might be a little smaller because it's only been around for 3 months. But in year 2, you're still going to use that same process. Since the adjusted book value at the end of year 1 is $21,600 because we only took $2,400 of depreciation in year 1. So in year 2, the adjusted book value of that asset is $21,600 that we then multiply times 40%. Okay? Now, guys, this is all estimates. The best we can do is based on past history and what we think these assets are going to render us. But estimates and residual values can change. When new estimates are made by management, they're used to determine the depreciation going forward. We never go back and fix what we've done. When management decides, I think this asset, instead of 5 years, is only going to have a useful life of 3 years. We don't go backwards and change anything. We only go forward and move forward by changes. So the depreciation expense that was recorded in earlier years, we don't fix that. We just, from the moment management changes its decision, we go forward with our changes. Got it? So assume that a machine was purchased on January 1st. The machine cost $140,000. We figure its residual value is $10,000, and it's going to last for 5 years. Okay? So the $140,000 minus the residual gives us $130,000. The $140 minus the $10. That $130 divided by 5 years is $26,000 a year. Let's assume at the end of the second year, the machine's book value, that adjusted book value, is now sitting at $88,000. So now, because we've taken 2 years of depreciation on it, our adjusted book value at the end of year 2 is $88,000. At the beginning of the third year, the company says, oh, I think now, instead of, originally we thought this equipment was going to be useful over 5 years. Now we're saying the remaining useful life is now 8. Instead of 3 years left, it's now 8 years left. And we think that residual value, instead of $10,000, now it's going to be $8,000. So going forward, year 3, going forward, we're going to adjust our depreciation. We're now going to show the $88,000 is the book value. We now show a residual value of 8, which means we have $80,000 is the depreciable cost, divided by 8 years, means now going forward, we're going to depreciate $10,000 a year. We don't go back and fix anything. We just go forward with our new information given to us and adjust the depreciation going forward. Does that make sense? Yes? So, at that moment, when the company changed the figures, what happened here is done, but now we move forward with the new figures. Okay? Once a fixed asset has been acquired and placed into service, costs may be incurred for ordinary maintenance and repairs. Costs may be incurred for improving an asset or for extraordinary repairs that extend the asset's useful life. Costs that benefit only the current period we call expenditures. They're expenses. They're expensed in the current period. Costs that could improve or extend the useful life we call capital expenditures, or basically we add that to the asset. Think of this. Okay, cars aren't my best, but I do know that oil changes are needed every 3,000 to 5,000 miles, depending on what kind of oil my husband puts in the car. Okay? So I know oil repairs are repairs. It's needed to keep a car just running. Got it? Or tire rotations are just normal maintenance repairs. Okay? Or if the car needs a tune-up and new liquids or whatever you call that stuff, it's normal. But if we put a whole new engine in the car, will that probably extend our life of the car? The plan is it should, right? Or if it's a hybrid car, we add a whole new battery. I don't know, they're thousands of dollars, aren't they? Wouldn't that extend the life of the car? Does that make sense? So there is a difference between a repair and an improvement. Repairs get expensed. They're written off on the income statement as an expense in that period. Improvements are going to extend the useful life of that asset and therefore get depreciated along with the asset. Am I making sense what I'm trying to say to you guys? Can anyone give me a better example? You get the gist, right? Yes. Anyone? Okay. Costs related to the ordinary maintenance and repairs of a fixed asset are expensed in the current period. $300 paid for a tune-up is repair and maintenance expense. Extraordinary repairs, after a fixed asset's been placed in service, we can extend the asset. The engine of a forklift is near the end of its useful life and it's overhauled at a cost of $4,500, extending its useful life by 8 years. We call those capital expenditures where we increase the asset instead of expense them. Does that make sense? In this case, generally speaking, in this case, what they're doing is they're showing it to be an accumulated, we add it to the asset cost. After a fixed asset has been placed into service, costs may be incurred to improve the asset. The service value of a delivery truck might be improved by adding a $5,500 hydraulic lift to allow for easier and quicker loading of cargo. Such costs are capital expenditures and are recorded as an increase to the fixed asset account. Here we would debit our delivery truck and we would credit our cash. In this one, I guess they're calling it an extraordinary repair, and they decrease the accumulated depreciation. I'll be honest with you. This is the first semester I've had this book, and I don't see this. I usually see everything gets added as an asset improvement. So that's a first, just so you know. If you get that wrong, I'm not going to beat you up because I've been doing this a lot of years and I've never seen it done that way. Usually if it extends the life, we treat it as an asset. No. If it only benefits the future period, we expense it. If it's an extraordinary repair, they're saying in here, we debit our accumulated depreciation. Otherwise, we increase our asset, which adds to the service value. Interesting. Now, Miller Electric Inc. purchases a piece of equipment to use in its manufacturing process. The machine costs $65,000 and has a residual value of $3,000 and a 10-year useful life. Miller Electric uses the double declining balance method of accelerated depreciation. What is the amount of depreciation that will occur in year 2 of the asset's life? Let's just first start with what will happen in year 1. If it's a 10-year life, what would normal straight line be? 10%, wouldn't it? But in double declining, wouldn't it be 20%? Right? So 65,000 times 20% is what? 13,000? Right? Someone help me, see if I'm wrong or not. Let's go in here and just let me see. Wasn't it 65,000? And 10-year property, wouldn't it be 100 divided by 10? Wouldn't that be 10% a year for straight line? But for double declining, wouldn't we say straight line times 2? or 20%? %? So 65,000 times 20% is what? 13,000. So the new adjusted book value would be the 65,000 minus the 13. Wouldn't it be 52,000? So our new adjusted book value is 52,000. That times 20% in year 2 would be what? 52,000. Wouldn't it be 10.4? Do you agree with me? Is it making sense? Let's see if we're right. 10.4? Oops. Now, guys, let's just go back to what I was doing. What would be the new adjusted book value at the end of year 2? Wouldn't it be the 52,000 minus the 10.4 or 41.6? Then, wouldn't this in year 3 be the 41,000 times 20%? 8320? Do you see how we're doing that? And then wouldn't in year 4 but what was the residual value? Maybe it didn't tell. But do you understand what I'm doing here? If it tells me it has a residual value of 3,000, I can keep going here, can't I? Right? But do you see what we're doing? I don't want to. 5325. But the minute I get where I'm going to be below 3,000, I can't take any more. No. Whoops, I screwed up here. $42.60. $34.08. Do you understand what I'm doing here, guys? The bottom line is I cannot let myself get below the adjusted book value of 3,000. If I kind of want to show this to you so you understand what I'm doing. One, two, three. I don't think I'm going to. I'm not going to. If I end up below that $3,000 mark, can only take enough depreciation to get to that $3,000 mark. Okay? 41,633. Okay, moving on. So does everyone understand this answer here? How we figured out year 2. How about this one? Bridger Ski Company has developed a tract of land in a ski resort. The company has cut the trees, cleared and graded the land and hills, constructed ski lifts. Lifts, not lifts. Should the tree cutting, land clearing, and grading costs of constructing the ski slopes be debited to the land account? Yes. All of those costs are getting it in its asset intended for its useful use. In its intended use. If such costs are debited to the land, should they be depreciated? Did we hear we cannot ever depreciate land? Ever. Now, can we depreciate light fixtures? Of course. Can we depreciate sidewalks? Of course. But the actual land we cannot depreciate. Got it? How about this one? Convert each of the following estimates of useful life to a straight line depreciation rate stated as a percentage. The way we would do this is 100 divided by 4 is 20%. 100 divided by 8 is 12.5%. 100 divided by 10, 10%. 100 divided by 17, 6.25%. Do you see what I'm doing? I'm just taking 100 and dividing it by the number of years to come up with the percent. 100 divided by 25, that should be easy. What is it? 4. 100 divided by 50? 2. Are you guys getting this? This is like math. I didn't mean to make that sound rude. But do you understand? You just 100 divided by the number of years. Got it? How about this one, guys? A refrigerator used by a wholesale warehouse has a cost of $85,000, an estimated residual value of $4,200, and an estimated useful life of 8 years. What is the amount of the annual depreciation computed by the straight line method? How are we going to do that? 85,000 minus 4,200 gives us what? 80,800 divided by 8 years. Whoops. Oh, I didn't even put that one in there. 80,000, here, 85, 42, 8 years. Let me just do it this way. The cost is 85,000. The residual value is 4,200. Here's the cost, residual value, and the depreciable cost is the 85 minus the 42, 80,800. Over 8 years, okay, guys, 100 divided by 8 is 12.5% a year, right? So wouldn't we take cost of the asset, 85,000. Depreciation rate is 12.5. But we only can take that based on the depreciable cost of 80,800. So this depreciable cost, 80,800 times 12.5, our depreciation each year is well, isn't it basically 10,100? Right? each year. Got it? How about this? Let's try to figure it out using double declining. If the cost of the asset is $85,000 and straight line would be 12.5%, what would be double declining method? 12.5 times 2, wouldn't it be 25%? Right? Wouldn't that be 25%? I don't want this to be, well, so basically 85,000 times 25% would be the 85,000 minus 21,250. Wouldn't our new amount be 63,750? Right? That times 25% would give us our new value. And what is our residual value is the 4,200. So then here's our new book value times 25%. Our new book value times 25%. Do you see how we continue to figure this out? Then but when we can't go below the 4,200, won't we then stop? Oops. So here's the catch. For this one, we can only take up to 25%. What is 25% here? 1178. But do you see, we can't go below 4,000. So because we can't go below 4,200, do you see all we can take is the difference of the 4,714 minus the 4,200 to get to that $4,200? Do you see what I did there? If I would have used that 25% figure, what would have happened? I would have gone, the residual value would have gone lower, and we can't go below 4,200. Make sense? Yes? Okay. Next. A Kubota tractor acquired on January 6th at a cost of $90,000 has an estimated useful life of 10 years. Assuming that it will have no residual value, determine the depreciation for each of the first 2 years by the straight line method and by the double declining balance method. I'm going to run to the restroom real quick. I want everyone to try this, okay? Remind me to put the sound back on, okay? Oh. For this one, $9,000 a year for straight line, $18,000 for 2 years. For double declining, remember we adjusted after year 1? The 90,000 times 20% is 18,000. And then in year 2, wouldn't we just take 20% of 72,000? Got it? Guys, so important to know we adjust it each time. Does that make sense? Yes.
Is it only in the second half of the year that you round up to the next month? Right? Like,
correct.
Let's say you bought it October 8th, then you say November 1st. That's only for the second half?
No. October 8th would be October 1st.
I thought you rounded down. I thought it was
up until on October 15th, or October 15th on, you round it to the next month.
So like the halfway point of the month?
Correct.
Oh, sure. Got
it? Again, this book is different. In the other books I've taught, and I've been teaching since 2008, and even doing it, I always, if it's October 8th, I go from the 8th to the end of the month. So again, there are some differences within books, but since this book is telling us to do it this way, that's how we're going to do it, okay? I think what I'm trying to tell you is, even in accounting with scenarios like this, I've never done it this way. You know, for tax I do, but in this scenario, I don't. Okay, here is another question. Equipment acquired at a cost of $105,000 and an estimated residual value of $12,000 with an estimated useful life of 10 years. It was placed into service on May 1st of the current fiscal year, which ends on December 31st. Determine the depreciation for the current fiscal year. Guys, I know this sounds really silly. I count on my fingers because people get it confused. You will think September 1st. Oh, 2 months or 3 months. No, count September, October, November, December. Count them. Okay? When you say May 1st, that is how many months? 8. I mean, you shouldn't have to count on your fingers, but I'm trying to explain to you that make sure you're right, okay? So, in this scenario, $105,000 minus the residual value divided by 10 years is, but we only can take 8/12 of it, is the $6,200. The 105 minus 12,000 divided by 10 years would be 9,300. But you see in year one, we can only take 8/12 or 2/3. Okay? In year two, we take the whole 9,300. For double declining, 20% of 105,000 times 2/3 is going to be 14,000 in year one. And then in year two, we have to subtract the 105 minus the 14,000 to come up with a new depreciable base times 20% to be 18,200. Does that make sense? Okay. A building with a cost of $2,200,000 has an estimated residual value of $85,000 and an estimated useful life of 40 years and is depreciated by the straight line method. What is the amount of annual depreciation and what is the book value at the end of the 28th year? So remember here, we take the cost of $2,200,000 minus the $85,000 divided by 40 years is going to be $52,875, right? What is the book value at the end of year 28, the 28th year of use? Wouldn't we take the $2,200,000 minus 28 years of depreciation to come up with the $719,500 residual or book value? And what is the depreciation expense for each of the 5 years if we only think there's a 5-year life? $131,000 a year. Yes?
Is the residual value basically how much you think it's going to be when it's no longer operational, like when it's just like scraps?
Correct. Correct. And it's an estimate. Okay. Now, assets can be disposed of. There's 3 ways they can be disposed of. You can sell them, you can trade them in, or you can retire them. Fixed assets that are no longer useful are either discarded or sold. We need to remove them from the books. If a fixed asset is no longer used and has no residual value, it's discarded. The discarded asset, along with its accumulated depreciation, are moved from the accounts and the ledger. Let's assume the equipment acquired at a cost of $25,000 is fully depreciated. In that case, to get it off the books, and we've depreciated all of it, don't we debit the accumulated depreciation account, credit the equipment, and it's zeroed out and it's off our books? Right? Straightforward. It's off our books. If an asset has not been fully depreciated, depreciation should be recorded in that current year before removing the asset. Assume that equipment costing $6,000 with no estimated residual value is depreciated at a straight line rate of 10%. The accumulated depreciation balance after adjusting entries is $4,650 on December 31st. On March 24th of the following year, the asset is removed from service and discarded. So the first thing we need to do is show the depreciation for that short period of time, which will debit our depreciation expense of $150, credit our accumulated depreciation of $150. Then, if we're just discarding it, we're not selling it, we need to remove it from the books. To remove it from the books, we need to zero out the equipment, which we had for $6,000. We need to zero out the accumulated depreciation, which is now sitting at $4,800. And the rest is either going to be a gain or a loss. In this case, it's a loss because we're not selling it. So we would show on our books loss on disposal of equipment for $1,200. Why? When we zero out the equipment, we zero out the accumulated depreciation. We don't balance yet, do we? Do our debits equal our credits? No. That's why we have a loss on our books. Make sense what I'm trying to say to you? The entry to record the sale of a fixed asset is similar to discarding the asset. The only difference is we're going to have cash. If the selling price is more than the book value of the asset, we'll show a gain. If the selling price is less than the book value, then we'll show a loss. Assume the equipment is purchased at a cost of $10,000 with no estimated residual value, and it's depreciated at a straight line rate of 10%. The equipment is sold for cash on October 12th of the 8th year of its use. The balance of the accumulated depreciation account as of the preceding December 31st is $7,000. The entry to update depreciation for 9 months is going to be the $10,000 times the 10% rate times 9/12. And the reason we're doing 9/12, think of this. We sold it October 12th, right? So remember, if it's before October 15th, we're going to go back to just 9 months of depreciation through September. So we take our depreciation of $750. We then know our accumulated depreciation is now sitting at $7,750, right? Right? And the book value of the asset is $2,250. if we sell it for $2,250, do you see how there's no gain? Because we sold it exactly for what the book value is, right? We zero out the accumulated depreciation account, we zero out the asset, and we show a cash, there's no gain or loss. But what if we only sold it for $1,000? Do you see in that case there's going to be a loss of $1,250? And if we sold it for $2,800, we would show a gain here of $550. In this case, guys, remember our debits must equal our credits. What about this one, guys? Consumer Gas purchases a delivery truck for $48,000. The truck has an estimated life of 6 years and a residual value of $6,000. The company uses the straight line method of depreciation. At the end of year 4, after the depreciation's been updated for the year, the accumulated depreciation on the truck is $28,000. The truck is sold for $16,000. What is the net result of this transaction for the company? 48 minus 28 is what? Adjusted book value of 20, wouldn't it be? If we sell it for $16,000, won't we have a loss there, guys, of $4,000? Right? Equipment acquired on January 8th at a cost of $212,000 has an estimated useful life of 15 years and a residual value of $14,000, and it's depreciated by the straight line method. What is the book value of the equipment at December 31st, the end of the 5th year? Well, we would have taken 5 years of depreciation. So 5 years of depreciation at $13,200 a year would have been $66,000. So the cost minus our accumulated depreciation, wouldn't it be $146,000? Make sense? Then it asks, we need to then, whoops, sorry. There. Then it says, assuming the equipment was sold April 1st of the 6th year for $105,800, we need to record the depreciation for that certain period of time. Excuse me, I'm screwed up here. We need to show that depreciation for 3 months and then show the sale of $105,800. We need to zero out the equipment account, zero out the accumulated depreciation account, which would be the $66,000 plus the $3,300 we just showed as depreciation. And based on that, we're going to either have a gain or a loss. In this case, we have a loss on the sale of equipment for $36,900. Is this making sense, guys? Yes? Kinda? Same thing here. Depending on a gain or a loss, you're going to, if you sold it for $360,000, this specific exercise, you would have a loss. But if you sold it for $370,000, there would be a gain here. Your debits have to equal your credits. Natural resources. Some businesses own natural resources, timber, minerals, oil. These are still assets, but they're not necessarily a fixed asset. The characteristic of natural resources and assets created through natural growth or through the passage of time, such as timber. Timber is a result. The assets consumed by removing it from its land source. And the natural resource is removed and sold over a period of more than 1 year. Mainly timber, oil, natural gas is a big one down south. Natural gas is a huge one down south. As natural resources are harvested or mined and then sold, a portion of their cost is debited to an expense we call depletion. Depletion is determined by the cost of the resource divided by the estimated total units of the resource. We multiply the depletion rate by the quantity removed in order to come up with a depletion expense. Assume that Karst Company purchased mining rights. We have a cost of the mineral deposit and the estimated total units and how many were mined that period. So the depletion expense will be the cost of the mineral deposit divided by 1 million tons to come up with how much per ton they get to deplete. Since this year they mined 90,000 tons at 40 cents per ton, they get to write off a depletion cost of the 36,000. So know that for natural resources, we'll also, it's like depreciation, except we call it depletion, and we'll also have an accumulated depletion account also. Depletion refers to harvesting and mining of a natural resource. Which of the following would be more likely to be subject to depreciation rather than depletion? Depletion would be trees in an orchard, because those trees in an orchard are going to be utilized for greater than a year, aren't they? Because they're getting apples off of them to sell. Make sense? Yes.
It's kind of off topic, but like a grocery store or something where they have like perishable items like stuff. How do you like write off that?
Now that isn't a depreciation or depletion. That's inventory.
When like something goes bad, they don't sell it.
Then they just expense. They put it right into cost of goods sold. So after the say lettuce or everything's got to use a shelf life. Once they don't sell it, they just expense it, put it right into cost of goods sold because they can't sell it. Bread, that happens a lot. No long-term assets that are used in the operation of a business but don't physically exist are called intangible assets. With intangible assets, instead of using the word depreciation or depletion, we use the word amortization. Patents are a huge intangible asset. This is when manufacturers acquire the exclusive right to produce or sell goods with unique features. Such rights are granted by patents. Usually these patents are good for 20 years. The initial cost of a purchased patent is treated as an asset. The cost is written off over the useful life by amortizing that intangible asset. Usually amortization is always the straight line method. Here's the weird thing, guys. We don't have a contra account for amortization. When we take an intangible asset and write it off, you know, with equipment, we write accumulated depreciation, or with depletion, accumulated depletion. We don't do that with intangible assets. We actually credit the intangible asset. It's not used, the contra account, for intangibles. Assume at the beginning of a fiscal year that a company acquires patent rights for $100,000. Although the patent will not expire for 14 years, its useful life is estimated at 5 years. So we report the adjusting entry over 5 years. Even though the patent may continue for a period of time, it's up to the company to determine how useful that patent is going to be. Whenever companies develop their own patent, research and development are always expensed. So if you develop an internal patent, there is no cost there because all research and development for internally developed patents are expensed. Copyrights, an exclusive right to publish or sell a musical or literary or artistic composition. This is interesting. Copyrights extend for 70 years beyond the person who authored it, their death. Yes.
If you're the company who came up with the patent and someone else is purchasing the rights to it, so you would debit cash, what would you credit?
Again, sale of the sale of a patent.
Sale of patent.
Mm-hmm. Copyrights are issued for 70 years beyond the life of the author's death. The cost of a copyright includes the cost of creating the work plus any other costs of obtaining the copyright. Trademarks are another intangible. Trademarks need to be renewed every 10 years. Goodwill is the most unique of them all. Goodwill is an intangible asset from a business that's created usually when you sell the business. Goodwill allows a business to earn a greater rate of return than normal. We never amortize goodwill. Know that Face Card Company has determined that $250,000 of the goodwill created from the purchase of another computer needs to be added. Or excuse me, this is an impairment. Let me explain. Goodwill occurs when one company purchases another company for greater than its value of all its assets. Okay? Now, why would someone do that? Because there's value in the name or value in whatever business you're taking over. There can be what's called impairment of goodwill, which means what we thought this asset had may not in fact be there. This scenario, a company was purchased, and when an asset such as goodwill gets impaired, what that means is that goodwill value is not there. When an asset gets impaired, we write down our goodwill and we have to show a loss. Goodwill occurs from purchasing an asset, but there are times that that goodwill is no longer valuable. No, in this scenario, these are the four most common intangible assets: patents, copyrights, trademarks, and goodwill. Patents and copyrights can be amortized. Trademarks and goodwill will never be amortized. And know that primarily for goodwill, there can be an impairment loss if the fair value less any carrying value occurs. Just know that. We're not going to worry about discussions. Financial reporting of long-term assets. I want you guys, because I'm running out of time, to look at this fixed asset turnover rate, which is a common ratio for companies. You see various turnover rates for various industries. And lastly, there are scenarios where you can exchange one asset for another asset or a trade-in. So I'm going to have you look at this. I'm so sorry I've run out of time. I will use my time better next week, I promise. But when there is an exchange, you may have a gain or you may have a loss on the exchange of an asset. Any questions before we end, guys?